good evening, depending on where in the world you are watching this from. This is a discussion for the launch of the IMF's Global Debt Database, the 2021 update. My name is Martin Sandbu. I'm the European economics commentator at the Financial Times. Today, I'm the moderator of what's going to be an exciting discussion with a great panel on what the update of the debt database shows. I am joined today by Vitor Gaspar, the head of the IMF Fiscal Affairs Department, who will start by presenting the latest findings and the database. And we also have Carmen Reinhardt, chief economist at the World Bank, and Anna Galpin, law professor at Georgetown and non-resident fellow at the Peterson Institute, who will comment, give their insights, their reactions to what the database shows, and we will then have an interactive discussion. So thanks everyone for joining. This is obviously an essential event, essential update, essential information for all those interested in debt around the world, and for all those who don't know that they're interested, but really should be, because what happens to global debt is fundamental for what happens to our economies, as we are about to learn. I will hand over to Vitor in just 10 seconds, but I'll encourage you, if you're watching and you have a Twitter account, to use the hashtag #GlobalDebt, hashtag #GlobalDebt, if you want to put any comments online, ask questions. I will try to monitor that thread, and perhaps some of that can play into our conversation. But let's just get started. Vitor, over to you.
Many thanks, Martin. It's such a pleasure to share the stage with you, with Carmen, and with Anna. I think that the timing could not be better for the 2021 update of the Global Debt Database. I'm now going to try to share my screen and give you a brief presentation of some highlights from the Global Debt Database. The Global Debt Database covers debt outside the financial sector. And debt jumped up in 2020, the last year covered by the database, to $226 trillion, or 256% of world GDP. And that's what you see on the left-hand side. At 28 percentage points of GDP, this was the strongest surge in debt on record as countries struggle with the COVID-19 pandemic and its financial, economic, and social consequences. The previous statements illustrates the value of the global debt database. The GDD is the result of a multi-year investigative process that started with the 2016 October Fiscal Monitor under the leadership of Abdel Sanhaji and Maria Luz Moreno Badia. It is an unbalanced panel of 190 countries that has time series since 1950, and from 2001 onwards, the countries covered represent almost 100% of the relevant debt concept and GDP. This coverage is, I believe, unique in the available data on global debt. The presentation that I'm making today reflects the work of my colleagues Paulo Medas, Adrian Peralta, Roberto Perelli, and the research assistants from Virat Singh, Andrew Vomer, and Yuan Xiang. The GDD allow us to look at long-term trends. In this slide, you see Alpha Century of debt. And if we look at those trends, we see that global debt trended up, and so did all of its components: public debt, non-financial corporations debt, and household debt. Remarkably, in 2020, public debt has overtaken non-financial corporate debt to become the largest of the three components we consider. And you can see all of this on the left-hand side. But if you focus on the right-hand side and the group of advanced economies, you see that the trend is similar but more pronounced in what concerns public debt, that for advanced economies reached 124% of GDP in 2020. Now, let's zoom in on the last 25 years and look at some trends that single out country groups and some individual countries. And what you see here, which is most remarkable, is the increase in the prominence of China, in particular, when we focus on the trend in global private debt, where the contribution from China is almost on par with the contribution from the United States. Now, if we look at the most recent period, going to the year just before the global financial crisis, so 2007, we basically see that the trends are dominated by advanced economies, but also China. In 2020, advanced economies plus China contributed 90% to the 28 trillion debt surge. What you see in this slide is what we call the great financing divide. On the one side, we have advanced economies and China that were able to finance quite a pronounced surge in public and private debt. And as we go to developing countries, we see that these countries accumulated much less debt, and in 2020, they faced much higher interest rates and even constraints on debt. Advanced economies benefited in this period from very low interest rates, which is a point that I will elaborate on in a minute. So if we look at contributions to growth of debt in the most recent period, you see again the dominant contribution from advanced economies and China, and you see that the contribution from low-income developing countries is residual, almost invisible. And that was already the case in the previous slide, although shamefully I forgot to mention that at the time. Now, focusing on public debt, the situation is also very interesting. What we see is that the public debt surge in 2020 is comparable to the surge in debt during the global financial crisis, but the comparison is between one single year, 2020, with 2 years during the global financial crisis. What we see in the comparison between these two crises is that the primary deficit contributed dominantly as a driver of public debt change in 2020, and that was less the case in the global financial crisis, especially for emerging economies and low-income developing countries. At the same time, as we know, public debt accumulated quite substantially during the interim period between the two crises. But as you can see, the contribution from interest rates is much less in the most recent period. And for advanced economies, that reflects very low interest rates. It's also interesting to focus on the stock flow adjustment, SFA, which did play quite an important role in the debt surges in both cases. So important differences and some similarities in the two cases. It's interesting to look at the commonalities and the contrasts between these two important debt crises. And I will conclude now. I think it's fair to say that one of the most remarkable conclusions from the global debt database is the persistent increase in global debt in the last half century. It is particularly remarkable that the public debt increased particularly strongly business cycle after business cycle and is now above non-financial corporations' debt. High levels of private and public debt increase financial vulnerabilities, and policymakers have to actively try to prevent and, if necessary, manage the associated risks. Speaking of risks, with persistent high uncertainty, which is driven by the COVID-19 pandemic, policymakers have to perform a most daring balancing act, and that balancing act involves economic recovery and recovery in employment levels, structural transformation that involves population trends and the green and digital revolution, monetary stability, and financial stability. These issues play out over time in complex ways, and the need for agility and the need for strong institutions is more important than ever. Thank you for your attention. I'm looking forward to a lively and informative debate. Martin, please.
Thank you so much, Vitor. So much to chew over there, and some that a lot of people probably feel quite worried about. I'm going to ask now your fellow panelists to give their reaction, starting with Carmen. Carmen, you are, of course, among many other things, the co-author of a book called "This Time Is Different." That was very influential when it came out in the previous financial crisis and the previous jump in public debt. And that's an ironic title because, of course, what the book shows is that most often times are not different, even though in every debt episode there seem to be rationalizations for why the debt that's taken on is sustainable. But of course, there are reasons to think that this could be true today as well. Interest rates are at record lows. Maybe there was no choice but to take on all this debt. So maybe this time is different after all. What do you think?
Oh, Martin, the first thing I really want to do is, before tackling your very important question, is congratulate Vitor and his team. I think this really, this database fills in, a very important, provides a very important big picture on what is, I think, and will be one of the most pressing policy issues, not just of the moment, but because debt is possibly easier to increase than to reduce. It will be with us for some time. So I really want to congratulate them on a fabulous contribution. Is this time different? In March of last year, I wrote a short project syndicate piece saying this time truly is different. The drivers of the debt surge, and I wasn't specifically talking about debt when I was saying this time truly is different. I was talking more broadly about the drivers of the crisis that we've been engulfed in the last 2 years. You know, a global pandemic, not since over a century ago, the influenza. The influenza was at the height of World War I, so it's not a very useful prior example to cite as to what to expect. So a big difference that I highlighted also is that unlike most crises, including the 2008, 2009, it truly is global. Global in the sense that we really hadn't seen something this encompassing since the 1930s. In effect, in 90% of the countries in the World Economic Outlook, and there's 196 of them, you had significant output declines. Where it's not different is, which is why I also congratulated Vitor on the timeliness, as he noted, of this report, is that I think, you know, having the same problem and expecting a different outcome is not always the best road to preparedness. And I want to highlight the vulnerabilities, as Vitor did, but let me expound on some of those, of the vulnerabilities of the current situation. I think the database shows that the situation is complex. It's far more complex than it was at the end of World War II. At the end of World War II, it was about public debt accumulated during the war, but the private sector was by and large mean and lean, or lean and mean, whichever way you want to put it. That's not the case now. Now we're dealing with highly leveraged corporates, households, and governments, and you know, what is private debt before a crisis becomes public debt after a crisis. So we really have to look at the global picture that these data present, and it is, you know, it raises questions of how will policymakers cope with this surge? You know, how will it be unwound? To what degree will it be unwound, and how quickly? And there are no silver bullets out there to reduce debt. All of them involve some element of trade-offs, and often are economically painful. Let me conclude by modifying something Vitor said, and I'm sure he will be very in 100% agreement with me. He highlighted accurately that the advanced economies in China have accounted for, you know, the dominant share of the surge in debt, and that is absolutely true in dollar terms. But let me say that a little goes a long way in the middle income and especially the low income countries. Even smaller increments in debt can lead to insolvency and debt crises. And that's in effect where we are. This is not a hypothetical. If you look at the low income countries, and I will stop here, the low income countries, that 73 countries that are part of the debt service suspension initiative, well more than half of them, around 60% of them, are either already in debt distress or fast approaching it. So I do want to reiterate every message that Vitor made, but add also the work that even smaller increments in dollar terms, because of the much smaller size of their economies, have meant significant debt burdens for the middle and low income countries as well.
Thank you so much. More to chew over there, and I think perhaps more cause for concern, but we'll get to that in discussion. Let me first turn to Anna to get her initial reactions. You are, of course, a legal expert, and debt, well, they are financial relationships. Debt relationships are financial relationships, but also legal contracts. Debt is, you know, a set of very specified legal obligations to pay certain amounts at certain times, unlike some other types of investments. What do you see in this data? What story does the database tell you?
So, Martin, thank you. And again, I want to reiterate Carmen's congratulations to Vitor and his team. And the one word that you didn't mention in describing debt as a relationship is, of course, a political relationship. And this is particularly acute when it comes to sovereign debt and public debt more broadly, which is, of course, continues to be an important and worrisome part of the picture we're seeing. But as part of my congratulations for the team, I also wanted to emphasize just what a valuable public service this is. One side effect of being at a law school is that, you know, whenever numbers start appearing on the board, everybody goes to sleep in the class. And I think that really discerning the relationship dimension of this bears emphasis. This is not just about collecting and analyzing data. This is an enormously important information forcing exercise in a world where information is shamefully scarce. And the fund and this database, in some sense, serve as a platform for negotiating our fundamental understanding of essential concepts. What is debt? Right now, seems obvious. Actually, there isn't a universally shared legal definition of debt, which should, I think, worry us a tad. Never mind public debt and private debt. You know, again, what is public and what is private is something that has to be negotiated and agreed upon. And what is domestic and what is external. And I could go on. What this exercise is telling me is that in a world of increasingly diverse actors and instruments, where instruments and debt categories that you never thought would be systemic suddenly become systemic and do so very quickly. The importance of this kind of an exercise, and I understand that, you know, so much of this information is teased out in consultation with country teams and country authorities to make sure that we're really talking about functional equivalence here. But it also tells me about just how much more work needs to be done. I mean, the irony of the fact that the biggest increase is in private debt in China, right? Just slowing down and just saying that sentence several times over again tells you just how much definitional, conceptual, diplomatic, political work needs to be done for us to get on the same page with not just you know, what it is that we're dealing with, but what vulnerabilities we should be focusing on. And of course, you know, it wouldn't be, I wouldn't be a lawyer if I didn't, you know, flag. The thing I'm worried about is not here, and it's not really the team's fault at all, but rather the terms of the debt. It has been my view for a very long time that public debt terms, not just financial terms, but legal terms, need to be presumptively out in public. How do we know how much of this debt is collateralized? How do we know the contingent liabilities that are that some of this private debt represents for governments? I think this just, again, emphasizes the value of this exercise and continuing this exercise and continuing to push the boundaries of what we're looking at and continuing to negotiate a shared meaning for all of this. Because as Carmen pointed out, the risk is non-trivial. Thank you.
Thank you so much. Anna, I'm getting some questions in that I will sort of channel as we discuss. And again, to anyone who's viewing out there and wants to put in anything on Twitter, we're using the hashtag global debt. I'd like to start with a couple of questions just on what's in the database. I mean, in the spirit of Anna's comments that there's even more we need to know. Vitor, I have one just to clarify, and there are a couple of others I've got in here. When you say this is debt outside of financial institutions, can you just clarify that that means debt that isn't owned from by one financial institution to another? But of course, much of this debt is owed possibly to financial institutions. So if you could just explain that sentence for those of us who are not experts. And let me add in another just sort of factual question about the database. There's a question about how many advanced economies and emerging market countries are in your universe of global debt. I think you showed a chart that says you have 100% country coverage. So I think the answer may be all of them. But why don't you answer that? I'll add one third one, also on sort of what's in here and what isn't. I have a question about how well do we understand the involvement of the shadow banking system in these debt relationships? And the questioner is worried about the rapid involvement, the rapid withdrawal of shadow banking in times of crises and what that means for how we understand the seriousness of this debt. So those are just sort of initial questions about what this actually tells us. Vitor, if you could address those, and then we'll have a broader discussion.
Thanks, Martin. So the database is what we call a unbalanced panel of countries. The coverage of the global debt database at around 1950 is non-representative of the world. It covers mostly what we now call advanced economies. As the date approaches today, the coverage becomes greater and greater. And in the years where we cover more countries, we cover at around 190 countries, which is not all countries, but it's many countries. The 100% indicators that I gave you is that these 190 countries cover almost 100% of world GDP and almost 100% of the relevant concept of debt. The classification of debt in the global debt database is done on the basis of the issuer of debt. The public debt is a debt which is issued by a government entity independently of the identity of the creditor. The creditor can be the general public, the creditor can be a commercial bank, can be a shadow bank, can be a central bank. The classification does not depend on who the creditor is. Then we have debt issued by non-financial corporations. So corporations outside the financial system is not covered, and household debt. So debt by households, and again, independently from the identity of the creditor. You had a third question that I shamefully forgot.
The shadow banking system.
Oh, the shadow banking system as such is not covered because, as I said, we don't cover the creditor or the financial system. So from both angles, the shadow banking is outside the scope of the global debt database.
So I take from that what we still don't know enough about, if we think that the identity of a creditor may affect how a debt crisis plays out, which seems plausible, then there are still unknowns out there. So I'd like to broaden this out to asking all of you, how worried should we really be? And can we focus, first of all, on public debt? You showed, Vitor, that public debt is both the largest overall amount now and what has increased by far the most. And Carmen, you started mentioning how for many poorer countries, debt sustainability is a real challenge already right now. I'd like you all, maybe we start with you, Carmen, since you brought that up, to contribute a bit more to this, elaborate on this discussion. How worried should we be about public debt? Are we really looking at a serious risk of sovereign debt crises coming down the line? And if so, what are the sort of policies or institutional reforms that are needed to be prepared for that? Carmen, maybe you would like to start.
So the issue of sovereign debt problems, of debt distress, is, as I said, not a hypothetical for low-income countries. Many already are there. And as the debt service suspension initiative comes to an end this year, perhaps, and we now have Omicron and another round of uncertainty and another round of potential delays to recovery. I think there is a reasonable expectation that the combination of delayed recovery, the suspension of the DSSI, the possible increase in international interest rates all go in the direction of contributing to the vulnerabilities that Vitor also and I have highlighted. You know, different countries, even within groups, but certainly across groups, have a different tolerance for debt. Let me start by making a point that I think is quite relevant to your question, which is this recovery has been exceptionally to date. The COVID shock and its recovery, to the extent that there has been a recovery, because many places have far from recovering, has been very unequal. So if you look at the share of advanced economies that are now at their all-time peak in per capita income in 2021, for the advanced economies, is roughly a third of the countries. For the low-income countries, it's only about 11.5%. And the middle-income countries are somewhere in between. So recovery has been very uneven, very uneven. And this also, I think, when you ask about specific vulnerabilities over the near term, clusters a lot of the risks in the especially the low-income countries, but also middle-income emerging markets, especially if international financial conditions tighten as a result of the big pop in inflation that we are seeing really travel across the globe. So I think the vulnerabilities for debt distress are importantly there. They're not there equally for everyone. You know, advanced economies have much longer ropes. But I would note that especially the protracted nature of the recovery, continuing uncertainty, and the prospect of rising rates are all adding to the points made by Vitor and this report on the pre-existing very high levels of debt. It's not a good combination.
Can I ask Vitor to come in, because I see his virtual hand is raised?
Yes, I would like to come in because there are two things that I would like to say that relate to Anna and Carmen earlier intervention. And the two aspects are actually related, so I think it works well. On politics, Anna, I was quite impressed by a reference that I got from Tom Sargent, and it's a reference to a US author of the late 19th century, Henry Carter Adams. And Henry Carter Adams saw the role of the US as an international creditor increasing, and he saw New York becoming as important as London or Paris as a source of funds for foreign governments. And he was basically saying that given that this prospect is so clear, the US administration must be conscious of what he called political entanglements that necessarily come together with the international debt relations. And it seems that this theme from Eric Carter Adams fits very well the theme that you were introducing, Anna, right at the beginning of your intervention. And it relates to what you were saying, Carmen. That is, the numbers, as you know, is that by 2015, we had 30% of low-income countries in debt distress or at high risk of debt distress. And the comparable statistic at this point in time is twice as large, at more than 60%. So clearly, it is necessary to find a way of dealing with excessive debts, and the mechanism that we have to deal with that is the common framework that allows us to deal, should allow us to deal with cases of debt insolvency or prolonged liquidity problems. But the common framework has not yet delivered on its promise. So it would be interesting, Carmen, if you would be willing to elaborate a little bit further.
Before Carmen does that, since you have the floor, you were showing data on debt stocks. I was just wondering if your database also has details on things like the currency denomination of debt, which of course can create further problems. There is one question about stock flow adjustments, which I think you mentioned have to do with exchange rate movements. Does it have information on maturities, which of course again tells us something about the risk of rollover problems? Is that information there, or is the overall stock of debt, the kind of nominal stock of debt, basically what we have?
No, so if you go to the global debt database, you will see by looking at information country by country that we have lots of additional information. Unfortunately, we don't have a uniform standard across countries, so the information that you're going to be able to find will vary if the country you're looking at is the United States, or if the country you're looking at is a low-income country somewhere in sub-Saharan Africa. So the standards are very different across countries, but we try to provide the more complete picture that we have available for each country in the global debt database.
Anna, what should we do about all this? What can we do?
Oh, I thought that was
you know
Carmen's
everything that needs to be known about restructuring.
I thought that Vitor pitched that very nicely to Carmen, but I'll start. So I think what Vitor just highlighted is supremely important. So 20 years ago, roughly, when you looked at, say, middle-income countries, the big problem was bonds, and the big solution was just change the standard bond contracts to make restructuring more orderly. Magic wand, problem solved. For low-income countries, it tended to be bilateral official debt, to some extent multilateral, Paris Club, which is a subset of bilateral creditors. You have HIPC and then MDRI, the Multilateral Debt Reduction Initiative. Again, problem solved. The irony of the common framework, great title, is that it's not really clear to me how much of it is common and how much of it is framework, right? Because so much of it is so thoroughly non-committal and relies on what would be precedent. So if we have a couple of very successful cases, then a pattern emerges, and then a kind of the law emerges, if you will, bottom up. The trouble is that the first three cases are not exactly low-hanging fruit success stories to be. These are very challenging cases, and we haven't had results. And at the same time, I think that the universe of problems is, and the diversity of stakeholders is just unbelievably greater than what we had in the olden days of bonds are the problem, Paris Club debt is a problem, right? So negotiating those shared standards, a shared idea of sustainability, making sure that what is restructured in the common framework is not then taken away in lost flows elsewhere or lost assets elsewhere is just an enormously tall order, which is why I'm not quite pessimistic, but I am apprehensive, shall we say, about the prospects going forward. I think we are at a moment of the greatest architectural uncertainty when it comes to debt restructuring that we've been in a long time.
The greatest architectural uncertainty in terms of debt restructuring is at least an open-ended place to be. Carmen, both Anna and Vito have partly deflected my question back to you, my question about what can we do about it in terms of policies and perhaps institutional reform. I would love it if you could contribute your thoughts, your recommendations about that. I will just read out a couple of questions that have come in that are related because people are worried about this. What kind of policies can the panel suggest to help low-income countries as well as emerging markets to put debt on a more sustainable and downward path? Would a second HIPC initiative be possible nowadays to ensure debt sustainability for low-income countries? What has the debt burden and the additional borrowing constraints and costs meant for poorer countries, and how does this affect development? Are we looking at reversals of SDG progress? These are the sort of things that are coming in. So again, if the problem is, if things don't turn out well, you've all emphasized the uncertainty here. If things don't turn out well, what are the sort of things we can do to handle it better than we've done in the past? Carmen, I will ask you first, and I will force the others to try to say more about it too.
Let me do two things. One is put the menu of what the options are on the table very quickly. And then within that menu, talk about what I think is the most likely outcome, especially for low-income countries and many middle-income that have debt difficulties, it goes back to Vitor's question on debt restructuring. But what is the menu? The menu, as we know it, involves you do fiscal adjustment, often necessitated to be fairly draconian, and that means austerity. That means you raise revenues, cut spending, or a combination of the two things. That will be very different. If and only if it is domestic currency debt, can you inflate it away? That's a question that a lot of people have been asking me in light of the recent significant increases in inflation. Is this a good thing for debt erosion? I would say that first and foremost, people should not forget that inflation is a tax. So it's part of austerity. Inflation is a tax. It is a tax that is a very regressive tax in nature. It hits the poorest households where the share of food and basics necessities have the largest share of the consumption basket. But inflation really doesn't work and actually is counterproductive when you're talking about foreign currency debt, which also goes back to the earlier question. A lot of the debt of the low-income and middle-income countries, despite very significant increases in domestic debt, is still foreign currency debt. So inflation doesn't help that. Financial repression, which is keeping rates low, which is something the advanced economies have been doing and are going to, I think, continue to do to the best they can, and keep negative real interest rates is another method, but that won't deliver a lot. In the end, for emerging markets, especially for low-income countries, what we have ahead of us is debt restructuring. And, I take very much to heart Anna's points that the complexity of the instruments being negotiated has increased. The number and complexity of the creditors has increased. But, I've been looking at debt restructuring since in my work with Christoph Trebesch and Josephine Meyer since the early 1800s. And there is one common thread. Creditors do not want haircuts. And they will only get to the haircut stage after they have tried a variety of things and all have failed. This goes to the heart of the question that you posed, Martin, on the HIPIC. The HIPIC came in 1996. The debt crisis for the low-income countries started even before the Mexican default of August of 1982. You started seeing defaults in 1980, and approximately a decade and a half later, you get the HIPIC. I'm not saying we're going to be that slow this time around, but if Anna is apprehensive, I am outright pessimistic on the expectation that we are going to see under the common framework or anything else, a swift move to restructure debts of those countries that need it, because creditors only get there after trying a variety of things like debt restructurings that do not offer deep debt relief. These involve things like very common in debt negotiations with China. They involve temporary grace periods, but don't get to the heart of the problem, which is reducing the net present value of the debt. And the average historical haircut, just to conclude on that, is close to 40%. And it takes a long time, on average about 7 years. And this is not just, and this is without the complexities of today. But as I said, at the core of the problem, leaving the instruments aside, leaving out who the creditors are. Creditors are not willing today to have a big bite taken out of existing debt. So it's going to be, I think, a long battle.
And Carmen, if I may, just to follow up on that, is it not the case that the longer it takes to get to those required haircuts and net present value reductions, the greater is the real economic damage associated with these episodes?
That is absolutely
generally
right.
True? Yeah.
That's absolutely right. 2 points on that very quickly. In a wonderful study by Borenstein, Panizza, Sturzenegger, they estimate that every year that a country's in default, real GDP is about 1.5% lower. In my own work with Christoph Trebesch, we have shown, and Josephine Meyer, we have shown also that the size of the haircut itself is importantly shaped by the magnitude of the output collapse from the start of the debt problem. So it is debt overhangs, loss of access to capital markets, unresolved debt problems are rather poisonous for economic growth. And hence, the common description of the 1980s is the lost decade for those countries that had debt problems.
Well, we all agree we don't want that to happen again. So, Vitor, I'd love to hear how you and the IMF, how you are thinking about this. How do we avoid this problem? How do we get to these net present value reductions that may be needed? The IMF, of course, has form of this. I'm thinking back to Anne Kruger's work on a sovereign debt restructuring mechanism. Your current managing director has talked about needing to update the architecture, I think is roughly the phrasing, improve the architecture. So what is the IMF planning to do?
So the MD, Kristalina Georgieva, and my colleague Ceyla Bazarbazioglu have written about the international debt architecture. That is the expression that you were looking for, Martin. And they struck a note of urgency for exactly the reasons that Carmen was talking about. The DSSI will expire at the end of this year. We need the common framework to deliver. One point that they make is that orderly debt resolution, when it is necessary, it's in the best of interest of both creditors and debtors. It is a coordination problem. And what they say is that it is very important to get procedural clarity for the common framework. That's the first element of what they suggest. They suggest also a standstill in the debt service payments for the duration of the negotiation. And they also stress, as Anna was doing, that given the complexity of the players, it is important to enforce comparable treatment of the various creditors in order to help solve the coordination problem. This is at this point in time a urgent priority. Some countries are already using the common framework and have been doing so for some time. And I don't remember if it was Carmen or Anna who said that early success could have a ripple effect in driving acceptability of the common framework and therefore making a solution to the various challenges that Carmen was listing easier. But when I look myself at low-income developing countries and look at the economic prospects as they look now, I worry that in the medium term, this group of countries as a whole is not expected to recover to pre-COVID-19 growth path in the medium term. So if we go up to 2024, 2025, they're not there yet. Perhaps also very concerning is the fact that tax to GDP ratios are projected to be permanently lower. And from the viewpoint of the question that you raised on the attainment of the Sustainable Development Goals, that is actually much concerning. And so when we think about that, we should do it in the context of an overall strategy of financing for development. And the challenge at this point in time looks much more difficult than what it did pre-COVID. So it's another element of urgency for global action to attain the Sustainable Development Goals by 2030.
Thanks, Vitor. Anna, I'd like to turn back to you, partly if you want to complement or add anything on what are the desiderata really of a system that can tackle these sorts of problems. You are perhaps freer than somebody with an institutional affiliation with a multilateral organization to say what really is needed. So please do that. But I would also like to talk a little bit about China in the time we have left. And you brought up China, and I think in the context of how much we still don't know. So I'd like you to reflect a bit more or elaborate on what are the sort of things, the dark patches around what we know about debt in China and whether that should worry us. Please, Anna.
That's a lot, Martin. Thanks. A couple of things. The system going forward needs to have two things. We need to have some sort of a surge capacity in response to shocks. And standstills are certainly one response for some countries, but it very much depends on the debt profile.
I think you have just muted yourself, Anna.
Ooh, I'm sorry.
You're back.
Immediate funding. And, look, COVID and Delta and Omicron are not one-off events. Given the climate shocks that we're expecting and public health shocks that we're expecting, I think this is very much the world we live in. So kind of systematizing our approach to standstills and sort of liquidity injections and surges in response to shocks, I think that's a distinct problem from dealing with long-term sustainability. And when it comes to that in particular, I want to come back to something that kind of comes out of Victor's last intervention. And that is, look, for whose benefit is all of this happening? For whose benefit is the borrowing happening, the repayment, the restructuring? To whom should the system be accountable? Right? And this, to me, I think is in some ways a big challenge of the common framework and of this idea that now we used to have a small creditor cartel called the Paris Club, and now we have a potentially bigger creditor cartel called the Common Framework, some such, that largely adopts perhaps the Paris Club process without necessarily sharing or kind of having hashed out the core values embedded in that process. And I think that to me, frankly, is the biggest challenge and the essential starting point, right? What is sustainable? What is comparable? Who is who is at the table? And to whom is this process accountable? I think is absolutely just an essential starting point. So to me, look, the procedural clarity point that Victor flagged from the managing directors and Jayla's intervention is essential, but procedural clarity is also part of accountability, right? So if we know to expect a certain series of actions, and if that is public, that's a commitment device. I do believe it's challenging, but it's got to happen, because otherwise we're just going to keep, kicking the same rusty can down the same dusty road. And in the end, it's not going to be good for anybody. Boy, I didn't want to be a downer. I'm optimistic deep down.
Carmen has her hand up, so I'm sure she's about to inject some positivity and optimism.
Okay, then maybe we can go to Vitor.
Please.
A couple of observations. One is also in response to your question of the role of China, but the other also is in the chat, I think an important question on the role of negative real interest rates and haircuts and how it connects to that. On China, two observations. One is, the aftermath of the global financial crisis of 2008, 2009 was comparatively really good for many developing countries and emerging markets. And in good part, it was because China was there as an engine of growth. Growth was double digit in the 2003-2013 period for China. And it was a catalyst, maintained commodity prices high, demand for products high, and it did a lot of new lending, which has come to roost, much of it at the moment. And so that kind of catalyst, that kind of locomotive effect is not likely to be there given China's own debt problems, as the property market has soured and other factors have driven growth lower, and its appetite for lending to emerging markets. So the role of China, I think, is going to be not anything like what we saw after the global financial crisis. Second part of the comment has to do with a question, well, why do we need haircuts if we have negative real interest rates? Negative real interest rates for whom? Certainly for the advanced economies, we have negative real interest rates. But if you go to the developing countries and to whether emerging markets or developing countries, especially, the riskier, more borderline countries, you're talking about in an era in which international interest rates in some of the advanced economies in nominal terms, let alone real terms, have been negative, those countries have been paying 8% and higher. So you know, the concept of negative real interest rate really has not been, and certainly, number one, it's so haircuts are still needed. You know, we're still in very positive real interest rate territory for most of those countries. Number two, economists really should be very humble about, you know, we haven't covered ourselves in glory in predicting turning points. And, you know, for the last couple of decades, we had downward trend in interest rates, in nominal interest rates, in real interest rates. But part of that, a big story of that was we had a secular decline in global inflation. And, you know, it's very soon to tell, but, you know, are we at a turning point? So is the idea in terms of assessing countries' vulnerability or assessing countries' needs to have debt relief. You know, the idea of assuming that rates are going to remain low and we may get a blip in 2022, but no big deal. That may be the case, but remember, you know, I think the track record on forecasting turning points, and this was true back in 1979 when we went, as a global economy, started going from high inflation to low inflation. There are big uncertainties out there on whether we are only temporarily deviating from the trend of the last few decades, or it's something more serious. It has real bearing for global interest rates. It has real bearing for debt vulnerability of many countries.
Thanks, Carmen. I think that's a good final word to end on, the difficulty of knowing whether we are at a fundamental turning point or not. A final word it has to be, because we're 2 minutes above time, unless Vitor, who's our host, wants to add anything.
No, I just want to thank you, Martin. Thank you, Carmen, and thank you, Anna, for a very enlightening exchange of views. To be continued.
Well, I also want to thank all of you for taking part, everyone who watched and sent in questions. And again, we may not know whether we're at a turning point, but I think the sort of knowledge we have in the global debt database at least helps us think about what happens if we are at a turning point or not. So with that, I will say thanks to everyone. Have a nice day or evening, depending on where you are. And everybody should dive into the update, I think, and learn more. Thanks to everyone.
Thank you.
Thank you.
Thank you.
Bye-bye.